First off, Alex, I'm curious what you make of the volatility that we've seen here in the equity markets. What does that mean for your business and for the global markets at large, this increased volatility we've seen?
Well, I think this volatility pattern that we've had now comes really on the heels of a long period of very low volatility, so it's really made it look a lot worse. Volatility in general isn't necessarily good, but I think when investors take a long-term view, it's something that they could ride out. Certainly there's a lot of products available for investors that allow them to take advantage of dampening the volatility that's going on in the marketplace while still maintaining their exposure.
There is, but do you think it's going to have a significant impact on index investing, Alex?
Not really, because I think this trend that we've seen, this mega trend of active assets moving into indexed assets, whether they be ETFs or index funds, is really driven by a lot of other factors, really the underperformance of active managers, the desire to see more transparent products, things like ETFs, lower cost products. So the short-term volatility, I think, is negative from an investor perception standpoint, but long-term I don't think is going to change these sort of trends.
And what does it mean for the ETF market, Alex? Because I know you've warned before that there could be some consolidation in the ETF market, especially among some of the smaller players, particularly ETF markets in Europe, or ETFs that are focused on European markets, for instance. What do you think the impact of this higher volatility is going to be on the ETF market?
Well, again, I don't think it changes the economics of the business. You know, you're seeing larger ETF providers that have the scale that are becoming more global players. But I don't think that's really a function of what's going on in terms of volatility. I think that's really just a natural evolution of the industry.
Right. You know, what we have seen in just the last couple weeks, or in fact, the month of March, Alex, that active funds seem to be staging a bit of a comeback here. I mean, growth funds, according to Bank of America Merrill Lynch, had more than 2/3 of their growth funds beat their benchmarks last month. So what investment strategies are going to be in favor this year?
So we don't actually forecast specific investment strategies, and I wouldn't necessarily create a trend out of just 1 or 2 months. I think the academic data, the research that we've published with our SPIVA reports shows that over long periods of time, it's very hard for active managers to outperform the benchmarks. That doesn't mean that there aren't managers out there in particular market segments that can outperform. I think that's just natural. But I think for the average investor, it's hard to find those managers. And again, when you look at it over the long term, which is really, I think, the way most people look at investing in things like ETFs and index funds, I think the advantages are still pretty clear.
Have you seen a pickup in investment when it comes to appetites in quant, smart beta, or traditional? I mean, what categories or themes are you watching out for this year?
So I think in terms of launch of new products, the big standard index products, they've been out there for many years. They'll continue to always to attract flows. In terms of new product launches, we've seen a lot of interest in what people call smart beta or factor-based indices, which are just new ways of dicing the market up in smaller ways and capturing different types of exposure to the marketplace. So I think that's still a growing trend. It's still relatively small compared to the big, large benchmarks, but certainly something of interest, and we have lots of interest from our customers in developing these sort of products.
And Alex, I want to talk a little bit more about China in particular. Of course, we've seen a lot of talk from Beijing and the Boao Forum about China is ready to open up. They're ready to open the financial sector, allow more access into the economy as well. What does S&P Dow Jones need to see to get a little bit more investor appetite into the Chinese market right now?
So we've been in China for quite a while, actually. We have U.S.-based products like the S&P 500 that are listed locally. There's China is a great opportunity in terms of the status of the market, the way consumers are starting to save. But there's also a lot of frictions right now in terms of the quotas that still need to be worked out before you have free flow of funds across the borders. And I think as those barriers come down, the opportunities are going to increase for firms like ourselves.
Yeah, and I know you're quite big when it comes to ESG as well, Alex. And of course, you're seeing signs of that in Japan. But corporate governance in China in particular, that's a pretty thorny issue still at the moment for many investors, especially when you're talking about the bond market, where we've seen just a flood of junk issuance recently. How challenging is it to really apply these ESG principles to a market that is opening up, but already so big?
Well, I think ESG is really a global phenomenon, not just particular to China. One of the challenges with ESG is that there aren't really global standards. Different views of social issues and governance issues in different markets mean different things to different investors. So more and more, I think we're seeing investors want to incorporate these. Here in Japan, GPIF is actually taking the lead in incorporating ESG factors into their own portfolio, and we're seeing it from the largest funds globally trying to do that. So over time, I think this trend will continue. China clearly, I think, wants to be viewed as being more environmentally friendly. And so again, I think looking at green bond issuances, things like that will be paramount to being accepted on the global stage for them.
And Alex, before I go, we want to ask a little bit more about India as well. I mean, there's been a bit of controversy, I guess, when it comes to some of the exchanges there. They've cut off their licensing deals on equity derivatives with their overseas counterparts. Some have suggested that this could actually jeopardize the country's weightings. What's your view on it?
We don't take a particular view. I mean, India is an important market for us. This is something really between the exchanges and their licensing patterns. We, of course, have a joint venture with the BSE for the use of their data for local indices. But it's something that I think, we're all watching, but it's really a question for you to ask of the exchanges.